All right, good evening. Here we go. Sorry I'm a couple of days late, but better late than never, excuse me. So, yeah, I'm just over here working on an updated underwriting template for you guys, which I'll give you a sneak preview of right here, but we'll go over that in the next session. So, to start tonight, we actually are going to go into our February stuff, and I have not rehearsed this, by the way, so you're getting live and what am I trying to say, unfiltered. Let's go ahead and open our quick underwriting template to have that ready to go. This is what we're working from today. And if I go back in here, I want you to notice, so we did the Blackberry Creek example in class, but I'm going to work through one of your homework solutions here. We're going to use these 5 properties over the next several weeks, mainly because they're a good case study. I've worked with a lot of these before and hopefully can remember a little bit of what I did on them. But anyway, this is a pretty large deal that we went after and we actually wound up losing. So I don't mind sharing these financials with you because I don't own them anymore, or I don't own them at all. So I'm going to use this property from Chattanooga for the example tonight, and we'll just kind of choose different ones to go through at different points of the curriculum. If you want to go ahead and poke around and look at the offering memorandum website or look at the offering memorandum itself, there's a lot of good information in here. We are going to go over this in the future, not tonight, but that you can kind of start getting a taste of what information is kept in there. So anyway, let's go ahead and open up our T12 and our rent roll. Let me get it on the right screen here. Let's see. Our rent roll as well. Here we go. And I'm just going to close this one so we don't have it in the way for now. Okay, so let's go ahead and start through this. And I really want to focus more. I mean, we focused on using this side of the template last week or last month. I want to focus more on what you can do with this side. And this is really about putting the deal structure together. And you got to understand it at the very basic sense before we can go much further. So let's just put our underwriting date in here, 2/17/2020. It helps if I put the slash in there properly. This is called Ridge Side Apartments. And I don't remember how many units it was. Let's go look. Check our rent roll. If we scroll down to the very bottom, these are a bit bigger, by the way, so we're going to see what an actual long rent roll looks like. This should be 148 units. That sounds about right. So we'll use that for now, 148. And do I remember what these went for? I don't. So we're just going to put in a number of 70,000 times 148. Yeah, it could be about right. So let's go ahead and delete all this stuff out so we can start from scratch and fill this template out. Get rid of that, get rid of that, get rid of that, all these and that. Okay, so first thing we're going to want to do, as we've done before, is go through and figure out what our T12 income and expenses are just from a gross perspective so we can actually fill out our template here. So let's go to our T12. We're going to scroll down, look through here. Here's the total column. And we have, let's see, net rental income. You see what's going on there. We are actually going to go through one of these in detail in the future, by the way, probably starting next month, but not yet. So for now, we're just going to look for the totals. Total other income, total corporate revenue. That's interesting. Consulting fee. Total revenue. Here we go. So our total revenue from a T12 perspective is this number. I'm going to put that in here. Total expenses. If we just scroll down to the bottom, we're not going to focus on what's in the expenses as of yet. That will be total operating expenses right here, $706,853. I'm going to do the same thing here as well. And then let's go get our T3 income, T12 expenses. So these are going to be the same. And then we're going to look at the T3. So let's go back up here to the overall income. Let's look at what that was for the last, I'm just going to calculate it here. So let's do sum of the last 3 months. We're going to multiply it times 4 because we have to annualize it. So that gives us 119. Let's just copy that number, paste it right here. Well, that's interesting. It actually went down. I don't remember that. Oh, yeah, that makes sense. Looks like they had a pretty bad month in June. Could have been some hefty move outs or something like that. We'll interrogate that later. Point is, that's where it is. We're not going to fill out your own pro forma at the moment, just because we're not going that far yet. So I want to focus on this side. So just I'm going to cheat and tell you that this should be about $300 per unit. Fills that out for us. And then let's assume we're syndicating this deal because it's a $10.3 million deal. Let's just assume we're going to target to keep 30% for ourselves, give 70% to the LP investors, limited partner investors, and we will go from there. Now, you see a lot of things aren't calculating because we don't have this filled out yet. So let's go work on this. So now we need to put the deal structure together. Going through the primary mortgage section, you're always going to have one of these. So this is kind of your main area to start with. From a down payment perspective, until you know otherwise, start with 25%. If it's in a less desirable market, let's say, I don't know, Lawrenceburg, Tennessee. Sorry if anybody lives there, but that's a small little town. Lenders don't like it. That'll probably get about, you're going to have to put down 30 or 35%. Somewhere like Chattanooga, I don't know if you guys saw the recent news story, but that's supposed to be one of the, if not the leading job growth town in the Southeast, and if not the nation this year. So there's a lot of good things being said about that. Lenders are probably going to give you full leverage there, which would mean 20% down or 80% leverage. Until we know better, remember, let's start with 25% down, and we'll improve that if the lenders give us indication that we'll get that. CapEx financed, this is going to be, if I am doing a short-term loan, like let's say this property is not stabilized. We determine that it's got 30% vacancy, and the lenders aren't going to give me good permanent debt on it. So Fannie or Freddie aren't going to give me good debt on it. I could do what's called a bridge loan, or a loan to bridge the gap until I stabilize it. These guys do things a little bit differently. They may want me to they'll allow me to do what's called loan to cost instead of loan to value. Whereas, so 75% down on a permanent loan is loan to value. They're going to calculate this based on the value of the property that you buy it for. With loan to cost, they're actually going to finance your down payment plus, maybe 75% of your CapEx need for, rejuvenating the property and fixing deferred maintenance and things like that. So anyway, this property isn't that situation, so we're going to put 0 here, but just know that that's what that's for. That would basically add the CapEx that you're going to finance to the mortgage amount. Interest rate. At the time, there was some pretty tumultuous things going on the mortgage market back when the yield curve inverted, and Fannie and Freddie actually ran out of money shortly after that. So there was a big problem, but I think we were setting around 4.6 at the time. And remember, we can do this as 250 years for the amortization term if we want to model interest only. But remember, I do that for you here. You always have interest only calculated in here just so that you can see the benefit of one over the other. So we're just going to put in the traditional 30-year IO at this point, or 30-year principal and interest period for amortization. So that calculates our mortgage. And if you see here, now things are actually calculating over here, which is a good thing. Not seeing some very good numbers there, but we'll get over there in a minute. What we also want to figure out is what we can actually pay for this property based on these in-place financials. So the next part we want to talk about is this secondary mortgage information. This is what you call a supplemental loan or a secondary loan. You're always going to have the primary mortgage. You're not always going to have this. So think of this situation where perhaps I have used this section below, which we'll come back to, and I've assumed an existing mortgage, and maybe that mortgage only covers 50% of the purchase price. Well, you don't want to put 50% down. That's going to really hurt your cash on cash return. So A lot of lenders will let you take a second mortgage, sometimes only with themselves. So, for example, if I have a Freddie Mac small balance loan with Hunt Mortgage as the servicer, and I'm assuming it from someone else who originated that loan 5 years ago, and now they've paid down enough where they only, based on what they're selling the property for, it's only covers 60% of the value. Hunt might say, okay, you can't take a loan with anybody else, but you can take in a second loan with me, and I will give you an additional loan to value. So I could let's just say that my down payment was going to have to be like 50% here. Well, that's ridiculous. I mean, my cash on cash is so tiny at that point. I could say, well, okay, Hunt will give me an additional, let's say 30% here, additional loan to value percentage. That would effectively mean I'm only bringing 20% down to the table, and that calculates over here with our total down payment. So instead of bringing 5.1 million to the table, I'm going to get a mortgage for 3.1 of that, a second mortgage, and that helps me reduce how much I'm actually having to bring to the table from a down payment perspective, and that very much improves my cash on cash. So just watch this for a second. Look at our cash on cash return numbers. If I make this 0, my cash on cash just dropped dramatically because I'm having to bring $5.1 million of a $10.3 million purchase just to cover what's not on the current loan. If I then bring that 30%, my cash on cash shoots up to like 13%. So it's pretty powerful being able to put a second mortgage on something when the time is right. This is kind of like a unicorn. You don't do this much, but it's good to know that you can. And then, of course, I didn't fill this all the way out. We'd also need to fill in our interest rates. This is usually going to be higher, by the way. So maybe this is 6%. Your lender can tell you what that would be if you're looking at this situation. Amortization term, maybe it's interest only, maybe it's 30-year AM, maybe it's 25-year AM. I don't know. You got to talk to your lender. But we'll also calculate our debt service, and then that would be included in this number over here. Here's something I want to show you. So let's say we've got all this baked in. CapEx finance works the same way, but we're just going to say that's 0. If I have 50% down with my current mortgage and 30% down with my second mortgage, it calculates for you. That's effectively an 80% total loan to value. So you can see how much leverage you're actually getting on that debt service. So anyway, that's kind of how the second mortgage works. Let me blow this one away for a second. Well, sorry, we'll just leave it there so you can see how this works. I've been talking this whole time as if this was an assumed mortgage because we were demonstrating what secondary does. The actual area you would use an assumed mortgage for is right here. This is another rarity, but let's go back to that situation where someone bought this property 5 years ago. They have a mortgage that covers 50% of the asking price. And let's just assume for a minute that was a good deal. If we say there's a little yes or no button here, so it says select yes if mortgage assumption. So this means, okay, the seller has a mortgage in place. He can't get out of it. He's got to sell the property with the mortgage. And I, the buyer, have to go in and qualify for that mortgage and take it over, assume it. So if that's the case, we're going to say yes. And watch what happens. When I do that, you see that number just drop dramatically. I'm going to watch that number again. If I go from no back up to 558 because it's including the debt service from here and from here. But if I turn this to yes, because it's assumed, it's now ignoring this and it's taking debt service from here and from here. Okay. So the reason we do this a little bit differently is when you're assuming a mortgage, you don't really get to set the terms. Okay. It's easier just to say, okay, I'm assuming his mortgage. What's the mortgage amount? And more importantly, what's the current monthly payment? So let's say that mortgage is $12,000 a month, $144,000 a year. That's going to drive your number over here. This is a simple way to do it. When I'm using my more advanced calculation techniques that I will teach to you at some point, it's more about, you actually have to know when the mortgage start date was, so that you know exactly where in the amortization period you are, because it could have been one of those complex mortgages where you have 3 years of interest only and all that kind of stuff. So you got to know, well, when I'm taking it over, do I still have any interest only period left, or how far into the amortization am I? What's my balance? So anyway, that's complex stuff that you don't need to worry about now. Just know that it's out there. So anyway, let's turn this to no, since we're not doing that. And I'm gonna go ahead and zero the secondary stuff out, because we're really not going to use that for this deal. But now you understand how the whole mortgage area works, and that's very important, because when the art of putting these things together is understanding how to stack the debt and capital stack, right? So debt is always, always, always going to be cheaper than equity. When you start giving equity to investors, not only are they going to want payments to the tune of 7 to 10% out of your cash on cash return, compare that to your 4% mortgage interest rate. They're going to want part of the proceeds at sale. Your lenders don't want that. They just want their money back, right? So equity is always, always more expensive. So you want to minimize how much equity you need to bring and maximize how much you can mortgage of the amount that you're going to go after. That does not mean over leverage your property. That just means if I had to choose between paying 4% for some money or paying 10% or more, or even 20%, if it's if I'm giving equity at sale, then you probably want to choose the cheaper. So it's better to figure out how you stack that together to be more efficient. So anyway, that being said, so we're back to our mortgage here. I'm going to put this back to our 25% down, so it's more normal. Now, if we look at total down payment over here, this is kind of your total acquisition cost. Like, this is the amount of money it takes to get you in the deal. This is the amount of money, if you're syndicating, that you're going to have your investors bring to the table. Maybe you bring a percentage of it. It depends on the structure. But mainly, or if you're buying this deal by yourself, this is how much money you need to bring to the table. Whatever it is, this is how much money you need to acquire the property. And so these are your real costs before you start making money. So we already have our total down payment, which is pulled from all this information over here. It's going to, take any amount of down payment that's necessary. It is then going to do, so we need to put closing costs in. As I mentioned, closing costs of 3% is a really good assumption up to about 150,000. They simply don't get this high. Okay. I mean, some things are scalable, some things are not. I mean, your third party reports, your legal fees, I mean, things like that, they're going to be kind of set based on, regardless how big the property is. And there's some of it that is a percentage of the loan amount, but it doesn't get this high. So I usually say use 3% up to about 150,000. Let's just see what that looks like. Oh, that's pretty close. So 1.5% gets about 150,000. Cap it there. Loan point costs. We're going to assume that this lender is going to charge me 1% of the loan amount, or 1 point, to get into this loan. And let me remember. Okay, for J, this is M7 times J8, M7 times J8. Good, okay. Sometimes I see people calculate this as a percentage of the purchase price. You can do it either way. This is more conservative, it's a bigger number, but really it's a point off the loan amount. Acquisition fee. Let's just say that we're working as syndicators on this one, and we're going to be raising this equity from investors, and we likely have probably looked at 300 or 400 deals that didn't work out before we actually got to this one. So that there's some overhead in doing so, and you've got real costs that are involved in actually outlaying earnest money and putting your money at risk, and legal fees and everything like that. It is a noteworthy thing that the acquisition fee is part of your payment for that. So this is industry standard. Don't balk at it. But 1 to 5% is customary. We do 2 to 3%. Just to start with 2%. But this can be the first thing to go if the deal doesn't work or it's marginal. Maybe you start dwindling this a little bit, but make sure you pay yourself. I mean, investors really want to see that you're well compensated, because then you're more likely to make their money perform if you're well compensated than if you're not at all. So anyway, CapEx need. This is very important. This is saying how much money do we need to spend on the property in order to take care of deferred maintenance? How much money do we need in terms of operating reserves? Just things of that sort. I don't know any better yet because I haven't gone through with you and shown you how to find that in the offering memorandum or anything like that. So we're just going to say we think we need to spend $3,000 a door on this for now. Okay. So this is a good thing to check. Total acquisition costs. If it's above 40% of purchase, ask yourself why. Or why you're buying this property. It might be a little bit too high for you, but we will get into another day what the pro forma looks like and why you might say that's okay in the future. But for now, keep it around 30 to 40% or less. Which if you look at this actually says above your 25% you're bringing 9% more in closing costs and acquisition fee and stuff like that. So anyway, total acquisition cost. Now let's go over here and look at what we have. So we've shared with our investors 30%, 70. Let's just walk through what we've got here on performance. So income and expenses. This shows that we're at about 53% of gross scheduled income for expenses. That's a little high, but 40 to 50% is not bad for a well-run property. Don't let anybody tell you it's 25%. That's BS. Net operating income, CapEx reserves, we set that. So NOI less CapEx is here. And then we put in debt service. This is where we start to get down to how much money we have. Ooh, look at that. So for at 10.35, based on their T3 income and T12 expenses, they're losing money. They're not trending well. That's interesting. Cash on cash return is very low. Okay, so if you were simply targeting at this point, will the banks lend on this? These are all below 1.25, 1.3. Banks won't lend on this as it is. Not wisely anyway. Cap rate, it's important to know this. The market cap rate in Chattanooga is around 6 to 6.5% at best. It's actually getting a little bit worse than that. So this isn't somebody might pay this for this property. But okay, the cash on cash return is very low. Even at interest only, it's 3% based on T3. We'll look at their T12 and not focus on the T3 because that's actually hurting them. But if I say, well, at what price would I actually like this? Let's just see what happens at 9 million. I do that. And by the way, I'm likely to get interest only on a loan right now, so I'm okay looking at this as long as I'm at 9% plus, preferably 10% in year one. Okay, I'll go with it. I'm not quite there yet, so let's say 8.5 million. Okay, 10.1%. So I think I like this property at 8.5 million. GP share. So basically that means that if we're keeping 30% based on that money, that's that. We're going to give this much to our investors. The investor cash on cash return in year one is 4.7%. It's a little skinny. But this is where we might say, okay, well, this is all we know on the performance of the property. Maybe we want to figure out and talk to the broker and say, well, do you really think these need $3,000 worth of repairs per unit? Maybe it's only 1,000. If you do that, then perhaps that number becomes a little bit better. More work to do. But this kind of helps you look at a property in the beginning and say, look, is it even making money? I mean, really, I just want to try to get this thing to a 9 or 10% total cash on cash in year one. That's kind of my goal. And the reason I say that's okay is I'm only going to spend this money over here that we're talking about if I know I can go get a return on that investment and raise rents by a significant amount. And you don't see that here. We're going to talk about that in future sessions. But anyway, overall, you kind of see how to use this quick underwriting template to just vet a property, say, is it making money today? do I think I can actually make around 9 or 10% total cash on cash return? You can get a pre-look at what your investors are going to make and maybe play with this split a little bit. Like maybe you've got to go 80-20 to give them enough to be happy. I don't know. You can play with that a little bit. But yeah, that's kind of how you use this. So you've learned how to use the debt. You understand how to put a deal together with the acquisition costs. That's kind of just in a nutshell, how you structure a deal. Now, we will go over this in our next session and we'll get in a little more in the weeds because after this, let's exit out of this stuff. After this, we're actually going to get into a bit more of the, let's see, here we go. We're actually going to get into a little bit more of the pro forma underwriting. And just to give you a preview of what's to come, we'll start going through this more robust template where you're actually going to look through what does acquisition look like? This is what we're going to do next, like actually breaking out income and expenses and looking at rules of thumb and putting the deal together. In a follow-on session, we'll get into year one underwriting, like what are you doing in the first year? And then, of course, this is where it really matters. It's like when I actually put together a deal and I look at it year over year and what I can do in terms of raising rents and investing capital into the property, what's my total return? I mean, if I'm going to make 120% in 5 years or about 24% year over year, all right, we'll go for it. So anyway, let me know if you have any questions and we will talk soon. Push stop and